When governments need to build highways or corporations want to construct skyscrapers, they rarely pay in cash. They borrow the capital from the global bond market, an ecosystem that moves trillions of dollars every day to fund the world's largest projects. At its core, a bond is a formalized IOU. When an investor buys a bond, they are lending their money to an issuer in exchange for a legally binding promise to repay that debt on a predefined schedule. This promise takes a few standard forms. You have zero-coupon bonds, which make a single payment at the very end. You have fixed payment loans, like a standard car loan. And then you have standard coupon bonds, which pay regular interest along the way. A standard bond has three strict, legally defined components. The face value is the principal amount repaid at the end. The coupon is the regular interest payment made along the way. And the maturity is the exact date when that final payment is due. Because the issuer locks in these three terms the moment the bond is created, evaluating a bond as an investor comes down to one mathematical exercise: figuring out exactly what those future, guaranteed payments are worth to you today. To find a bond's fair market price, you follow a single rule: add up the present value of all its future promised payments. From year 1 to maturity at year N, the bond generates steady coupon payments and returns the face value. Each payment is discounted backward using the interest rate, converting future dollars into their equivalent value today to map out the total price. The interest rate dictates the strength of that discounting. If market interest rates are high, money far out in the future is worth less to you today, driving the fair price of the bond down. Let's apply real numbers. This 3-year bond promises $50 yearly in coupons, plus a $1,000 principal. To price it, we pull the first $50 back 1 year, the second back 2 years, and the final $1,050 sum back 3 years. Since a dollar in your hand today is inherently more valuable than a dollar promised 3 years from now, pricing a bond requires nothing more than systematically summing up those discounted cash flows. Once a bond enters the open market, its price starts to fluctuate. This introduces the concept of yield to maturity, or the total annualized return you earn if you buy the bond at its current trading price. Yield to maturity relies on 2 strict assumptions to be mathematically accurate. You must hold the bond until the very last day of its maturity, and the issuer must not default on any payments. If you know the market price, yield to maturity is the exact interest rate that solves the present value equation. It acts as the fulcrum point, making the bond's future cash flows perfectly equal to the price you pay today. This chart shows yield to maturity is a universal translator. We have 3 bonds costing $950, $1,000, and $1,100. They have different coupon rates and maturity dates, yet calculating their yield to maturity, they all funnel down to the exact same 5% return. By condensing different prices, coupons, and schedules into one number, yield to maturity strips away structural complexity, giving investors a clear way to compare any 2 bonds in the market. Bond prices and yields move in opposite directions. The logic is structural. A bond's coupon payments are legally locked. If investors demand a higher return, those fixed payments cannot increase. The only mathematical way to increase the yield is for the price to drop. We establish the baseline at face value.
If you buy a newly issued bond exactly at its par value, say $1,000, your yield to maturity precisely equals the bond's stated coupon rate. But if the bond is trading at a discount, meaning you pay less than that $1,000 face value, you're investing less upfront to receive the same fixed cash flows. Mathematically, your yield rises above the stated coupon rate. Conversely, if the bond trades at a premium, you pay more than face value today. You are overpaying for those fixed cash flows, which forces your yield below the printed coupon rate. Price adjustments are simply the mechanism a fixed coupon bond uses to align its locked-in payments with shifting market demands. Our calculations so far assume you hold the bond until it expires. In reality, investors frequently buy and sell bonds long before their maturity dates. When you sell early, yield to maturity goes out the window. Instead, you calculate your holding period return, the actual realized profit or loss from your specific window of ownership. Your holding period return combines 2 things: the steady coupon income you collected while you held the bond, plus any capital gain, or minus any capital loss you took when you sold it back to the market, divided by your initial purchase price. Selling early introduces price risk. A bond's quoted yield only guarantees your return if you never test its value on the open market. Zooming out from a single bond, we find thousands of previously issued bonds being continuously repriced by real-time trading. When bonds become more attractive, increased buying pressure hits the market. This surge in demand pushes the equilibrium price of existing bonds up, and because of the inverse rule, higher prices instantly force market yields down.
These demand surges typically happen when overall wealth rises, when expectations for inflation drop, or when investors seek safe haven assets. On the other side of the trade, issuers can flood the market with new bonds. This massive increase in supply drops the equilibrium price of existing bonds, forcing their yields up to attract buyers. Supply spikes usually occur when governments need to finance massive budget deficits, or when corporations borrow heavily to expand their operations. Macroeconomic trends don't change a bond's math. They simply shift supply and demand, and those trading behaviors dictate the baseline pricing of the entire fixed income market. Even with guaranteed mathematical payments, bonds carry three distinct risks that force investors to demand higher yields: default risk if the issuer fails to pay, inflation risk if future cash loses purchasing power, and interest rate risk. Interest rate risk is governed by a strict rule of time. The longer a bond's timeline to maturity, the more violent its price swings will be when market rates change. Long-term bonds lock your capital into a fixed rate for decades. If new market interest rates suddenly jump higher, your old, lower-paying bond becomes unattractive, and its price has to fall significantly to compensate a new buyer. We saw this play out aggressively in 2022. A massive spike in global inflation forced central banks to violently raise short-term interest rates. Because new rates spiked, the mathematical inverse rule took over. Existing, highly rated long-term bond prices plummeted to align their yields with the new, higher rate environment. A bond's contractual payments may be guaranteed by law, but its daily market value is always held hostage by time, shifting interest rates, and the laws of supply and demand. This video is for educational purposes only.